Let's talk about a creative way of buying real estate, and that is assuming mortgages and wrapping mortgages. So this is taking over the monthly payment and loan obligations of the current seller, especially if they're at low interest rates, and now they're yours. So I'll break that down. So let's say, for example, someone bought a house in 2020 or 2021, and they owe, say, $400,000 on this property on the mortgage, and they're trying to sell it for $500,000. You have the opportunity of gapping the difference between the sales price and the loan balance. It has to be in cash, so you do have to bring right around $100,000 in this example, and you can take over that mortgage. So I'll break down the FHA and VA here. FHA loans, you can actually assume and put your name on it. So this is now your loan you can write out for the entire 30 years, but you do have to be an owner-occupant of this property and fall under the FHA guidelines for the financing. So you can't just buy this as an investment and then rent it out right away. You do have to owner-occupy this property. And now let's dive into the VA loan. So every single VA loan out there is assumable. But when it comes down to assuming this loan, the seller of this property is going to want another VA buyer to assume it. Because what they'll do is they'll swap entitlements. And by swapping entitlements, it allows the seller of this property to get his full VA eligibility back to use it again on another home. Now, being a non-VA buyer, you can still assume this loan. You can put your name on the loan. That is now your loan. You assume all the terms and everything, even if you're not VA, but the entitlement of the seller is gonna be wrapped into that house. So his buying power on his next property is gonna be hindered due to your name being on that loan and him not getting that out of his name. So in both these examples, the seller's completely out of the picture. You own the house, you're on the title, you're on the loan, and you can ride this out for as long as you want. Both are owner-occupied as well. You have to owner-occupy these properties when you assume them. So let's say someone has a conventional loan on their property. A lot of people have just conventional financing on their properties. So how do you take those mortgages over? It's getting a little bit more creative, and this was called a wrap. When you wrap a conventional loan, let's say the same example, a $500,000 house and it's a $400,000 loan balance, that let's say they got like a 3% interest rate on and it's a conventional loan. So this technically is not assumable. You can't go in there and say, hey, financer, I'm gonna put my name on the mortgage and I'll start paying you and let me take this thing over. And it's not that easy. For FHA and VA, it is that easy. But this one you do have to get creative with. So by doing a wrap, you're gonna create a real estate contract. In that real estate contract, it's going to go over the terms of how you will be assuming this property's obligations, how much money you're putting down, and typically there's a balloon payment involved. So I'll utilize this example, the $500,000 house. You're going to put $100,000 down, so you're going to gap the equity between the loan balance and the purchase price, and then you're going to put a real estate contract together saying that you're going to be paying the seller's mortgage on their behalf. We'll use a 10-year term for this, and then there is a balloon payment due at that 10-year end. In this example, you're not really put on title, so the seller's still on title of this house. The seller's name is still on the loan. So you do have to structure this correctly because there's a thing called a due on sale clause that you have to be very cautious of. So when it comes down to having a due on sale clause, this means that the note servicer found out that the seller, he offed his loan to someone else and there's someone else on title and he's not the actual owner of this property, but he's the signer on the note. They're going to do a due on sale. They're going to call the loan. And now the seller has to pay back this loan within a certain amount of time and nobody wants this. So how do you get around that? It's what's called, that real estate contract we were talking about. This real estate contract, I try to put into easy terms of you're renting the property from them for a predetermined purchase price at that 10-year balloon payment with a down payment up front. So for example, you put that $100,000 down and you take over his monthly payments like you're renting the property from him for a course of 10 years. And after that 10th year is over, you're gonna have that balloon payment, you're gonna pay off the remaining portion of that mortgage, and now you will be put on the title. Now you will own that house. So it's almost like a glorified rent-to-own program that you're just making the monthly payments on the seller's behalf. So that one's a little bit more complex. When it comes down to really breaking it down, I can break that down in a different video of really how to do wraps and how to do subject twos. Those are a little bit more higher level, but there's still opportunity out there when it comes down to this. The easy ones are gonna be the FHAs and VAs. So they're fully assumable. You put your name on the title and it's a very above board thing. So by analyzing both these scenarios, we're in a very weird environment where we're just coming out of the 2020s. 2021 and 2022, there's a low interest rate environment of 3% interest rates, 2-point-whatever% interest rates. That's not coming around again. And we're in a window of opportunity where these people actually come to sell their properties and they don't have a massive amount of equity. This is why this strategy works right now, because there hasn't been enough time between then and now where they have realistically achievable gaps in equity. So let's say 5, 6, 7 years down the road, when you have to bring $300,000 to the table to assume these loans that have been paid down over time, as well as, appreciated in value. So the gap between having to bring that money into closing is very tight right now, especially if someone bought in 21 or 22, they don't have much equity. So the amount of cash you need to bring to the table to gap the difference between the purchase price and the loan balance is relatively small. But over time, this strategy becomes harder and harder to achieve because the more and more cash you'll have to bring to the table to assume those loans. So really utilize this information the way you want. But at the end of the day, I think the most important thing to do is ensure that you look at that tax record, see what kind of loans on this property before you purchase it to see if this kind of opportunity is available for you.